markets have been a lot more volatile in 2018. Now, it's easy to say that they've suddenly become very volatile, but the truth is they're really returning to normal. The abnormal year was 2017. And I think because the markets have had such a very good run since 2011, investors and commentators are looking for a reason to be pessimistic. They're almost not wanting to believe that you can go on making money from equities. What they're beginning to say is, well, this run's gone on for a long time, so what is it that's going to bring the market crashing back down again, as happened in 2008? And what is pretty typical is that the thing that markets focus on most is what caused the last collapse. And the cause of the last collapse was debt. So recently, there's been an awful lot of talk about the levels of debt that we've now got around the globe. When the scaremongers want to worry the world about the level of debt, they're quite selective on their statistics. So they'll pick a figure like, in 2001, the total amount of debt in the world was $60 trillion. In 2017, this had gone up to over $170 trillion, a rise of over $110 trillion in 16 years. Now that sounds like a lot of money, but it's irrelevant. All that matters with debt, as any bank or lender will tell you, is whether it can be serviced. And although debt has gone up and people are talking about the consumer being awash with debt, the worry is in the UK that borrowers are ramping up their credit again to buy houses, cars, spend on holidays. It's just not true, because the actual level of debt relevant to GDP amongst consumers has actually been coming down. But the scaremongers don't like to tell you about that. If you dig beneath the figures, you'll find that not only has the UK and US consumer not been increasing debt relative to their income, they've actually been paying it down. So, consumer debt to GDP in the States and consumer debt to GDP in the UK have both reduced relevant to GDP post the global financial crisis. In the US, consumers have reduced their debt by 20% of GDP. In the UK, it's about 15%. That is not a recipe for some big catastrophe coming down the pipeline due to individuals having too much debt. And of course, the issue is the way in which you present statistics as to how you understand whether the world has got too much or about right or too little debt. You take a statistic that takes a 2001 dollar value, $60 trillion, and you run it through to today, and it looks like a big increase. But what everybody forgets is our incomes have been going up in the meantime. GDP bit's going up in the meantime. So if you look at the average rate of increase, the compound rate of increase from 2001 to 2017 on debt, it's about 6.5%. But GDP's been going up globally by a not dissimilar figure. And you, in terms of working out the amount that's gone up, you can take the nominal increase. You don't have to reduce for inflation because the debt's not adjusted for inflation. So what you've got to look at is not how much the actual debt is, but how much is that debt relative to what people's incomes are. And when you do that, you find that debt is actually very affordable today compared to what it was just before the global financial crisis. So, consumer debt's down. Corporate debt has been coming down. Government debt has gone up. It had to go up post the global financial crisis because tax revenues dropped. Governments had to take a while to make cuts, and in the meantime they had to bail out the financial sector. So yes, overall debt throughout the globe is up a bit relative to GDP, but it's not been increasing in the sectors that created the 2008 credit crisis. So is the globe sinking in a bog of borrowing? No. If anything, we need to make a bit more credit available to consumers. Companies are able to borrow at reasonable rates, and governments need to be careful about the amount of debt they're taking on. But in the UK, we've got our borrowing down to a reasonable level, and that's happened most of the case around the world. Even Italy, which has been cited as the latest basket case, government debt there isn't increasing as fast as it used to. So debt is not the issue. The issue for the markets will not be debt. It will not be affordability of debt, which is okay. It will be this. When interest rates start to go up, the bond market will get blown up. And that will be the cause of the next major slide in asset values. And it's more likely to be in bonds than it is in equities. How have we done in 2018? We've done quite well. If you look at our year-to-date performance figures, we're very happy with them relative to peer group. We've been managing the volatility, very pleased with what we've done in that regard. We've been digging in and getting some reasonable returns. We were probably a little light on risk in 2017, looking back with hindsight, but I think all our investors expect us to be cautious with regard risk. But overall, we're getting good returns relative to the risk we're taking. And if you look at the figures so far this year, they're very strong. So I'm hoping we can keep that up through to December so that when I get on my feet in front of our clients for the end of year seminar, we've got good news to tell them.